Hello, everyone. My name is Margaret Businje, and I'm a financial professional. This is my pleasure to welcome you all tonight. This is our financial literacy Thursday, and we are very glad to have you all join us to learn together. I'm honored tonight to be co-hosting this session alongside Dr. Sharon Owanyuze, a professor at Missouri Science and Technology University, and my fellow co-host as well, Madame Serafina Mwisaneza. Together, we look forward to an engaging and insightful discussion. Tonight, we'll be exploring an important topic, breaking barriers to financial freedom. Get ready. We're going to dive in together. We're going to learn together and take this to heart to make sure that everybody is able to take something or two out of that. So among so many barriers, we thought let's talk about these few, and then we'll focus mainly like two, and then the other preceding Thursdays will actually go back and join into more topics. So the number one barrier we actually found was financial literacy deficiency. So really, this doesn't go to maybe someone who is not educated or not. You might have a PhD, you might have whichever higher degree you have, but if you're not financially actually literate, it might be hard for you to be able to achieve that financial freedom that you need. The obstacle becomes that people have limited knowledge, like of budgeting your finances, of investing, of debt management. So if you're not able to actually tackle those major issues, it is going to be hard, no matter how much money you're able to make. So they always say it's not about how much money you're able to make. It is about how much you're able to retain, or even how you're able to plan for that money that you do have. So another obstacle we found out was the lack of long-term financial planning. So we all work hard in this country. We really do work hard, but at some time we find that the obstacle people have, they focus on short-term financial needs. You know, I need to buy a beautiful car, I need to buy something. So we focus on the needs or something we feel like they are so appealing to us, and we forget that the future awaits us. And every time that goes, it is now going to be coming back to us. So the area we start actually focusing on those long-term planning, it is going to help us towards that financial freedom that we are all looking for. Another one is that the poor money mindset or emotional spending. You might think that who does have a poor money mindset? We make the money, it's hard to make it, but the way we spend it, that is actually an issue. So the obstacle there becomes like the negative beliefs and the impulse about spending your money, or even building your wealth, generational wealth. Don't spend every penny. It is good to spend because you make it, but think about the future. Then the absence of an emergency fund. You'll be surprised. People work so hard, but if something was to strike in a family, that maybe there is a terminal illness in a family, there is a critical illness in the family, and the breadwinner is not able to work, they're not going to survive for 6 months. That is a very crucial obstacle towards our financial freedom. So the obstacle becomes, what if an unexpected strikes? What do you do? At least the solution would be to maintain at least 6 or a year of funds that will help us on a rainy day. So don't look just, okay, I'm making money, the money will come next month, the money will come, I'm still working, because you never know what tomorrow will be bringing towards you or your family. So by overcoming these barriers, well, we strategize and plan and have discipline. So with this was just like high overview of those big major financial barriers. But I do have other speakers, my co-hosts again. They are going to go in deeper, mainly on that long-term financial planning. That is what we're going to tackle tonight. As we said, our financial Literacy Thursday covers a wide range of financial literacy topics, and every Thursday we'll be going to many. So without further ado, I'll stop here, but I'll be coming back, trust me. But I'll welcome Dr. Sharon Owanyuze to come in and give us the presentation she has for us tonight, and it will be followed by fellow business partner and financial professional, Serafina Mwiseneza. Dr. Sharon, you're on.
Thank you so much. It's an honor to be here. And I want to welcome again everyone that came here and to learn. It's an honor to be here and so that we can learn together. Our leader, Ms. Immaculate Businje, has been a community educator for some time now, for years, a few years now, and it's always an honor to see the work that you do. And Seraphine, it's also great to be serving with you today. Welcome again to everyone who is here. Just know that we are, here to share what we know. All of us information is power. So the more you know, the better it is for you and your dependents, if you have them. So I've prepared a few slides that I would like to share with you tonight. All right, so like you heard, today we're going to be talking about money matters and financial literacy, specifically on how we can protect ourselves and build this, financial freedom and build wealth at the same time. So just a little bit about myself. Like I was introduced so kindly. My name is Sharon Wanyuze. I'm a teaching professor here in Missouri. I've been here for about 2 years. I'm in the bracket of young adult. We'll see why this is important to the discussion, specifically to our young people in the crowd. Also, if you're unmarried or with no kids currently, I'm going to be highlighting the tool called Index Universal Life Insurance. Usually when we hear the term life insurance, we think it's something applicable for, people with families that are in their middle ages with kids and other dependents whom they cannot afford to live without financial care in case anything happened to them. But I'll be showing you today how you can use this tool to benefit yourself despite your marital status or your, having kids or no kids. And this was important for me a lot, that even when I was offered what we call group term life here at my job, I chose to forego that and keep the personal type of insurance plan with the savings benefit that I'm going to be sharing with you today. So again, the goal of the talk today is really to share what I've learned within these few years and learn so that we can learn from each other. And if you have any questions, please drop it in the chat and we'll be happy to discuss as we go. Again, also, I'm a teacher. I love it. So I'm going to be simplifying things because I'm not assuming that all of us know what these things mean. I'm going to try to use personal examples and just illustrations to drive home the points. Okay, so what is life insurance? Life insurance traditionally is really a financial safety net that you make in terms of a contract with a certain financial or insurance company to make sure that you give a certain premium per month so that in case the person is ill, terminally ill, or they pass on, their dependents get support if they were they dependent on that person as the breadwinner, like was mentioned earlier. However, right now there are some plans called the Modern Life Insurance, which I'm calling it Modern Life Insurance because it's the type of insurance that you don't have to die to use. And I'm going to be discussing on this later. Okay. So specifically for our young folks, again, here it's a safe space. It doesn't matter what age you are. It's just that I relate more to this group because this group tends to feel like, oh, we are healthy, we are young. We're not thinking about retirement or death or terminal illness right now. So that's why I'm going to be targeting that group for right now. Okay, so why get life insurance while you're young? The concept that I want to share with you, just to have in your mind to simplify this, is think about if you were to go rent a house, and you can get it at the cheapest rate possible, and you're promised that it's not going to raise with increasing inflation over time. So that's how I think about this, getting life insurance at this age. You know, the age you are right now is the youngest you will be. Tomorrow you will be a day older, and next year you will be a year older. Okay, so in terms of this specifically, you get to lock in the lowest premium that you can get, at least for right now. You get to secure coverage while you're still healthy. So it's important to note that being insured is a privilege. It's not that everybody gets to have it. They have to assess your health, your financial, your physical health and your financial health. Okay. So obviously, the younger you are, generally you're healthier than you will be, decades from now. So you're able to secure and lock in that low premium and based on the healthiest version of yourself. And then in addition to that, the specific plan that I'm going to emphasize is called Index Universal Life, which gives you the added benefit of a savings account. We always hear how it's important for us to save, but we know that keeping money in our bank, they only can give us 0.001 maybe percent, depending on your bank. But I haven't seen interest rates higher than 1 to 2% for the basic bank. But this kind of saving goes on rates that are around the stock market rates, which are much favorable. So it's attractive to put any little match savings you have in a part that is going to generate for you more. So an example again that I would give is buying this insurance at 25, for example, may cost you 150, which is going to be split into your savings and your insurance benefits. But waiting until you're 45 for the same exact plan, you're going to be paying about 400 per month. And these are kinds of calculations that if you speak to a financial professional like this, they would do for you the exact calculations and estimates depending on where you are, your family situation, how much you would like to contribute. And there are also different plans that can be personalized to you. I studied this when I was a grad student. People in the crowd, that when you're a graduate student, you're really earning slightly above minimum wage. But it did not prevent me from being able to do this at a rate that I could afford at the time. And this is something that is scalable. So as your income increases, you can always increase it to improve your savings accordingly. Okay, so like I mentioned, there are different types of life insurance, but I can break them down into two main groups. There's term life insurance and permanent life insurance. Again, still the same example of a home or renting. So you can think of term life insurance as renting and permanent life insurance as owning the home. So term life insurance will give you the benefits of if you're to be terminally ill or get like cancer, heart attack, you get a significant disability that you can't do everyday functions like feeding yourself or getting around. or unfortunately you passed, these are benefits that you can get. However, term life insurance, they only give you a set period of a maximum of 35 years. So if you pay a monthly premium for that, but let's say you live longer than that portion, all the money that you put in is not going to come back to you. So after that time, you have to buy a new plan. And of course, you're going to be older and in a worse health condition, most likely than you are right now. So the only benefit of term life that I see is for people who, let's say, have young. You can also pair this with the permanent life insurance, by the way. But the term life insurance, the monthly premium is very low, so you can pay, $50 and you still have a protection of 500,000, for example. However, again, you can pay that for 35 years, and at the end, you're not going to get it back if nothing happens to you. However, with permanent life insurance, you're protected for up to 120 years. So I have not met or seen a person on the news right now that has exceeded 120 years. If one of us makes it, that would be amazing. But this one is meant to be like a lifelong protection, where your premiums stay in and build up over time. In terms of if any of those things are to happen to you, terminally ill, chronic illness, unfortunately passing away, all these benefits will be available. However, you also don't lose your premiums over time because they become the source of your savings later on if you want to take them out during retirement or at any other point. So by the way, just a disclaimer, if at any point that I'm talking, you again have a comment, question, please note it down. I want to make sure that we are able to address any comments at the end. So what is this Index Universal Life? So this is a type of permanent insurance policy that acts like that savings account. So just to dive deeper into it, it's linked to the stock market. So people who have looked into stocks, you know that generally their rates, if you're dealing with, say, the SP 500, which is the top 500 performing companies, if you buy a stock in the ETF, for example, it's going to balance it out. Like the individual company may drop and then the other one may make higher, but then your stock doesn't fluctuate as much as, say, if you buy in one single company. So whenever we put our premiums in this account, they put it in this stock market. But the only unique thing again is that unlike the stock market, which fluctuates, even at a small rate, it still fluctuates, and there's a possibility of going in the negative. With the Index Universal Life, you're promised to not go below the amount that you already have. So you can't. That's called the floor rate. You don't go below zero. In addition to what you already have. Okay. So the other thing is that you can also borrow from it. It's like taking money from your own bank as you need it. Okay. So how exactly does this protect you? I personally love it because I didn't understand the whole concept of having to pay money to only benefit potential dependents later on when I die. So I really liked this because, again, it's life insurance that you don't have to die to use. And we know that we insure different things in our lives. We insure our car, we pay car insurance all the time. We pay if you own a home, you pay insurance on that. These days, you even pay renter's insurance. This is different from health insurance because health insurance also, first of all, they have to assess your health. If you have a disability or if you have a chronic illness, a lot of times either the premium is going to be significantly high or it's going to be difficult to get. So if you have any question regarding the difference between health insurance or life insurance, we are happy to address that. But with life insurance, again, some of the things we mentioned as living benefits, I want to define what those are because, I don't want to assume we understand the differences because I didn't. So living benefits include, again, there are three key terms. Critical illness means it covers conditions like heart attack, cancer, and stroke. Chronic illness, again, is if you have any problem, like you get into an accident or you suddenly develop an illness that makes you not to perform daily tasks like dressing yourself, eating, taking yourself to the bathroom. That's called a chronic illness. And then a terminal illness is you go to the hospital and they say you have stage 4 cancer. That's terminal illness. You can have a cancer that is called critical illness if it hasn't reached stage 4 or the terminal stage. Okay. So those are the key differences there. So it means that with this life insurance, if you got any of these, none of us is promised perfect health, for as long as we live. So it's always important to prepare for any rainy day in case that happens so that none of your dependents or you yourself has to start a GoFundMe because unfortunately we see so many of those around. Okay, so specifically for my working professionals in the crowd, why would you want to get your own Index Universal Life Insurance instead of getting insurance through your work? So work insurance that they typically give us at an institution like a university, like a company that you work for, is called group term life. It's temporary, so meaning that it covers you while you're employed. If you leave your job for a different job, you lose your benefits. If you retire, again, your coverage is not there. This will cover you if you die on the job, if you get an illness on the job, terminal illness or chronic illness while you're at that job. Say you work for the institution for, let's say, 10, 15 or so years, and then you leave. Obviously, you're going to be older, and your health assessment will probably not be as great as it could be right now. So your premiums will most likely be more expensive, or you may be denied coverage if it's in a critical stage. So we've talked about how it protects your life. Now let's talk about how it builds, the wealth over time. So it uses we've heard of this term compounding, right? Back in primary, we studied compound interest. So that's the same philosophy or theory that it's based on, indexing or compounding. So unlike stocks, which we've talked about, which are another common way that people invest, Index Universal Life locks in your gains and again promises or guarantees not to lose your money or go in the negative. So what you've put in at least is guaranteed to stay. It can only grow but not drop. So an example that I would put here to just help us understand this better is if the market goes up by 10%, say generally the stocks increase by 10%, your account will gain. If the market drops by 20%, you're not going to go to negative, 20. You're going to stay at the rate that you were at before the drop, which I think is great. I think of this again like a roller coaster for the stock market. And then the Index Universal Life is more like an elevator that either stays at the same level or goes up. Okay. So the other things that we know from working professionals, one is 401k. Here in the US, if you're working, they typically, if your company helps you do this 401k saving plan, they can deduct a certain portion for you and keep it for you for later. The only issue with that is that while right now it's not taxed, it's going to be taxed later on, and the tax rate then may be much higher than it is now. With Index Universal Life, it's almost like the money that I earn now is already taxed anyway if I go and put it in a bank. So that's how it is with Index Universal Life. It's taxed to start with, but then once it has accumulated over time, by the time I go to take it out at retirement, it's not going to be taxed, which I think is great because we don't know how the tax rate will be then. Also, I am allowed to take out money from the Index Universal Life Fund at any time. Obviously, the longer that I leave it in there, the compounding works better that way, but you never know when you would need it, that you would need to take it. The other thing that goes without saying is that obviously in the savings account in your bank, the interest is super low. There may be some fees associated to it too, and it doesn't cover anything with your life. Okay, so I'm kind of getting towards the end now I want to just give a couple of examples and real case scenarios. So here I did this illustration using someone that would be maybe close to my age or so. So say you start with this Index Universal Life at 30 years old and you're paying $200 a month. Remember that this amount it's like a two-in-one. You're putting some money in your savings that will grow over time, and you're also putting some money to help protect you in case of illness or death. So by age 65, your cash value would have grown. And this is an illustration that we can do like for real. These are not some made up numbers. This is actually a calculation that was done through these life financial professionals here. It would have grown at 300,000 and this would be tax free. Now, if you can get your phone or your whatever you have a calculator, if you do 200 per month times 12, in a year, that's around 2,400. Okay, multiply that by 35 years. The max you will get if this stayed at a minimal growth rate, like what you'd be getting in a bank, you would only get around 84,000 by then. Okay. Now, obviously, the Index Universal Life will grow much higher. Now, if you're to pass away at age 90, which would be a nice, generous lifespan, your family would still get that amount or any of the dependents. So when you get this policy, even if you don't have dependents at the time, you put a person in there to act as a beneficiary in case anything happens to you, and you've already put in this amount, these savings. Now, the lesson here again that I want to drive home is that with Index Universal Life, it's more like a retirement fund plus your life protection. Okay, so then for my people who are like, I'm not very sure, what about if I just wait and maybe I actually have a family and I have people who actually depend on me before I start doing this? And the only thing I can say to that is remember, time doesn't wait for anybody. I really wish all of us to stay as healthy and as insurable as possible, but life is not guaranteed. So I also did some of these. I asked the financial professional to put these numbers in to see these different plans if you are at different ages. So I just showed you at age 30. Now let's look at age 25, age 45, and age 55. So age 25, for getting this dual type of policy, you'd be paying about $150 a month and you'd get 500,000 in coverage. At 45, this is like 4 times more for the same coverage. And then at 55, you may not even qualify, because I remember when I went to get my plan, they ask who you when you got your last check, you have to give them your primary care provider, your physician, so that they really make sure that they want to take a risk on you. So obviously, the healthier you are, the better. They will want to take you under their wing, and the lower your premiums will be. Okay, so I want to end there. Again, just some highlights. Here are, while there are different life insurance policies and savings plans that people can take, one that I wanted to share with you all today was the Index Universal Life. And this is because you can lock in your rate specifically. The younger you are, the better, and the healthier you are, the better. You're able, if you have a family, you're able to protect your family, or if you're independent, you're also able to protect your future. It gives you an opportunity to grow your income, your wealth tax-free, and use it when you need it. And you can still get your living benefits for medical emergencies. If you would like to get a personalized calculation or plan, please feel free to contact ibfinancialfreedom@gmail.com or myself, and then I'll direct you accordingly. Thank you so much. I'll stop sharing.
Thank you so much, Dr. Sharon. That was amazing. Yes, we can't wait for actually everybody to chime in at the end. That was really impressive. Thank you. Madame Serafina, the floor is yours.
Oh, thank you, Emma, and thank you, Sharon. That was awesome. That was perfect. I couldn't say it any better. You are right on point. Once again, good evening, everyone. My name is Serafine Mwiseneza. I'm also a financial professional tonight. So in addition to what Dr. Shannon just went through, I'm gonna focus on why is IUL or Index Universal Life is a perfect gift for our children. This is a topic that deals to me as a parent. Hopefully, some of you also that are parents here, you can understand why planning for our children's future, planning accordingly and plan ahead is very important. So I would dive right in so we can see why children or their grandchildren, the perfect gift of an Index Universal Life. So like Dr. Shanna was saying, what is an Index Universal Life? An Index Universal Life, like you said, is an insurance. It's a powerful tool that provides life insurance protection, living benefit, and also provide a cash accumulation. So we're gonna learn why is that a smart choice for our kids. We're gonna learn why it's so important to get the Index Universal Life or IUL for the children at early age and how's it gonna benefit them in the long run. I know Dr. Shannon was discussing about a young adult. So let's see if it's so beneficial to young adult. What if you start kids at a younger age? What if we start them as a newborn? How far can it take them? So why consider an Index Universal Life for kids or IUL? So first is the lifelong protection. Also have tax advantage, tax advantage for the cash value growth, locks in premium at the lower rate because children are young, and also financial flexibility for the future. So what do we mean about when we say lifelong protection? So lifelong protection means the insurance coverage is not gonna change even if the condition develop later on in a life. So if it's a child obtain a coverage now at a young age, at the older age when their health condition change, let's say they get an illness or they get an accident and they are paralyzed, that's not gonna change the premium they're putting into the life insurance. So once you lock in the protection, once you lock in the premium, that's a lifelong protection. It's locked in. Premium will never change. A premium will never cancel as long as you're making, of course, your premium payments. Secondly, tax advantage for the cash accumulation. So, as you're paying into your Index Universal Life for your children, your money putting in is growing at the rate, and whatever rate is whatever cash accumulation is incurring is tax advantage, meaning when they're ready to take the money out of the cash, they take out the cash value, they can access the money tax free. Now, assuming the child puts money in today, you start finding the IUL today, you are at a greater rate of when the child gets ready to go to college, you can borrow the money or you can withdraw the money tax-free, buy your child a car, pay for the tuition, use it for whatever. It's tax-free because the money you are investing in the IUL is already tax funds. So all money that's been accumulated will be tax-free when it's time to withdraw, leading us to the lock in the lower premium. Like I was saying, the younger we are, the healthier we are, the lower is the premium. So that being said, if his child is young, that means there's a lower risk toward the child, which means they are more favorable to the insurance company because they are young, they have no condition. Therefore, their premium is cheaper. So I'll give an example. If you obtain a policy today of a 5-year-old, let's say of maybe a $500,000 death benefit, that'll be way cheaper than obtaining the same policy when somebody is 20 years old. So the younger you are, the earlier you take your policy, the cheaper and the lower is your premium. Now, what is financial flexibility for the future? So the financial flexibility for the future, that means the funds can be used for anything in the future. Is treated like Index Universal Life account, treated as your bank account. Once your money is in your bank account, you can use it for whatever, no question asked. You can take the money, go on vacation. You can take the money, buy a brand new car. You can take the money, start a business. You can take the money. So Index Universal Life is your own bank account. Once your money is in your cash value, you can use, is so flexible, you can use it for whatever you please. And remember about tax advantage, you can take the money out, use for whatever you want, attack with tax free without paying any taxes. So remember, Index Universal Life, it gave us the protection, cash accumulation, and also living benefit. So the living benefit, Dr. Shene touched on, the living benefit are the chronic illness, terminal illness, and also critical illness. So while you have what you can set up your child Index Universal Life, you are killing 3 birds with 1 stone. You have your death benefit, you have your cash accumulation, you're building asset for them for their future, and also you have the protection in the case of an illness. Because let's us remember, illness will happen. It's just a way of life, and we don't know when it's gonna happen. So it doesn't matter how young you are, an illness can strike at any time. So don't think about, oh, my child is too young, no need for me to protect for death benefit or chronic illness. We don't know. That's why it's better to prepare ahead than being surprised at the later time. So living benefit can be used while you're alive. So you can access your cash. Like I said, once you build the cash in your Index Universal Life, your child can access the money for education, to buy a home, or at the later age, they can use it as for retirement. Remember, if you start now, you start your child at a younger age. with Index Universal Life, the money you put in your account is guaranteed for a growth and never to lose money. Even if the money is tied to a stock market, even if the stock market goes into a negative, you are guaranteed to never lose your money. You're guaranteed to always have a whatever your baseline is. You never go into a negative. You're guaranteed to always gain with the market. If the market lose, you stay where you are. So meaning that your money is safe. It's better than having your child money, because I know most of us parents, we do invest for our children. We do put money in the bank for our children. But the money you put in the bank is earning you absolutely nothing. 0.001. Okay, while you can put your money in Index Universal Life and have your death benefit, have your cash accumulation, and have your living benefit as well. And you are guaranteed to never lose your money, but you are guaranteed your money to always have a positive growth. And when you're ready to take the money out, you can take it out in the terms of a loan, or you can take out time of a withdrawal. Either way you take it out is a tax-free. You can access the money tax-free. And it also has the protection of the chronic illness. So if your child get chronically ill, they are covered. If your child get critical ill, they are covered, meaning that whatever the amount you have as your death benefit, you can access the money while your child is chronically or terminal ill or critical ill to take care of your child. That will give you the ability, maybe if you're a full-time parent, that will give you an ability. Stop working, go take care of your child because you have enough funds coming in. That will give you the ability. Take your child to the best doctor available. That'll give you open up so many doors for you. Because imagine, as we are here, like I see parents who have children that develop an illness, where a child is in a hospital, who knows for how long. A parent cannot afford to quit working to go care for their child in the hospital. So you find children are left in the hospital by themselves to be cared for by the nurses and the doctors. Why? Not because the mother doesn't want to be near to the children, but because there's no means. Mom have to go to work to make the money so the other children at home can survive, so that the mortgage can be paid. So imagine if you have that protection that's already set aside, guarantees you, hey, if my child were to get sick today, I can afford to stop working for 6 months, take care of my child. I can afford to stop working for a year and take care of my child. And once your child gets better, and you can resume your life. So what if your child need a long-term care? It does happen where you get sick, you never recover. You get an accident, you never recover. That require a long-term care. Once again, I'm giving an example. I have a few friends of mine. They have children that have developed a long-term care. The child is in the house 24/7. So who's coming to care for them? Nurses. How do you think people pay for that? Some people don't have a means to pay for that. What if you can qualify for Medicaid or Medicaid? Medicaid. So all that has to be considered. So now that we know all this information, we need to think ahead. It's not only as an adult that we need to be protected, that we need this benefit. Anyone, especially everyone from a newborn up to as long as you're still alive, you do need to get yourself Index Universal Life. That will guarantee you are saving money for your future. It will guarantee you if you get sick, you can access the funds to care for yourself. And also, if you live a long life, you can access the money for retirement. So here, I'm going to compare an Index Universal Life versus a 529 college plan, which is most of this is an account that's only specifically for children, is the planning for college. So that's something. Am I still sharing my screen? Oh, yeah. Everybody see my screen? Okay. So 529 plan is very popular for college saving. So I'm gonna compare both of them side by side to show you 529 saving versus Index Universal Life. That way, as a parent can make any educated decision as to where do we need to allocate our children funds, as to where we need to put money, as to where we need to invest our children's future. So here we're looking at the IUL, which is the Index Universal Life. The funds can be used for anything. It can be used for education. It can be used to purchase a home. It can be used to purchase a car. It can be used for retirement. If you look here on the college saving plan, which is the 529 plan, is only for education expenses. Okay? You cannot use funds in your 529 plan to buy your child a car. No. You cannot use it to buy a home. You can't. You cannot take money out and give to your child here. Go start a business. No. It's only it must be used only for education expenses. How about tax benefit? So money in the Index Universal Life is a deferred growth, meaning you can take the money out tax free. Now, money in the 529 is only tax free if you use it for education only. Anything beside that, let's say you have money in a 529 and your child decide, I'm not going to college. First of all, money in 529, you cannot transfer to the sibling. So if you have to withdraw the money in 529 saving, that means you have to pay a penalty and taxes and whatever other fees that apply. How about market protection? Remember, we spoke about money in your Index Universal Life is tied into the stock market, but is protected from any market losses. Okay? You have a guarantee floor. So if a market perform in a negative, you have your guarantee floor, you never lose. If a market perform in a positive, you gain with the market. So how about the money in your college funds? It's subject to market fluctuation. So money in a 529, it goes into the market and it performs with stock market. Okay, it's a variable. So if a stock market gain, you gain with them. If they lose, you lose with them. So example, you can start with $5,000 today. Next week, if the market tank, you're gonna tank with them. You're gonna lose your 5K. But if you had the 5K in your Index Universal Life, your money is guaranteed to be there plus an addition or whatever your guarantee floor is, which here most of the Index Universal Life is about 0.75% guarantee gain if the market lose. So how about access to your funds? How can you access your cash? So money in the IUL, you can access anytime. You can withdraw it, like I said, or you can take it out as a loan. Now, people might say, oh, if I take a loan, do I have to pay back? No. Remember, it's your own money. You can loan it. That means you are loaning from your death benefit, or you can draw it. Now, versus the money in the 529 plan, there's a penalty for non-educational withdrawal. So if you decide I'm gonna go take out X amount of money so I can do X amount of whatever for my child, maybe buy them a car so they can drive themselves to college, that means there is a penalty. Okay, so let's look at the death benefit. Index Universal Life, remember, it gives you the three benefits: death benefit, a cash accumulation, living benefit. Versus the 529, there is no death benefit and there's no benefit offered by 529 plan, as also there is no living benefit. In case you get sick, you cannot go to 529 plan and take out money to take care of yourself. It's only made for college. So I just want to compare those two. I think those are two that I can compare beside the bank. The bank, we know everybody puts money in a bank. There is no gain in a bank. So what can we take out from this? So for parents or grandparents, think about this. You give your child the gift of Index Universal Life. You are guaranteed to provide a lifelong security, financial security. You are offering more flexibility than the other accounts we offer. Example, like the 529 plan I was talking about. The money in the IUL is protected against losses in the future or any future medical issue. So if you get sick, you are protected. Money in your IUL, you are guaranteed to never lose. So what I will encourage every parent and every grandparent is to please consider, look into it. Let's see how we can give our children a great start. See if we can build a foundation for them. The only way as parents we can guarantee to leave a legacy to our children is by giving them that foundation. By giving our children foundation, that will enable them to give their children a foundation as well. And that's how family build legacy. We're not gonna build legacy by clocking in 9 to 5. We're gonna build a legacy by leveraging this financial institution that allows us to purchase a big amount of money for a small premium every month. That way, if something ever happened to us, we can leave it to our children. If our children, something ever happened to them, they can leave it to their children. But it all starts with us as parents or grandparents. Let's give them that foundation. Let's give them that foundation. Even if you're saving $1 a day for a child, even if it's $2 a day for your child, that's gonna be in the long run, it's gonna accumulate and start building the solid foundation for them. So when they get to an older age, they have enough cushion so they can pass it on to their children, or they can use this for themselves during retirement. All right, so if anyone have a question or you like a personalized Index Universal Life for your child, please reach out to me or reach out to somebody, the person that invited you here. The financial professional that invited you here, reach out to them. Be like, hey, show me how can I make sure my child is Index Universal Life is set, so I can start saving in case everything I mentioned here happened. So if you can reach out to myself, you can reach, my number is 817-703-2845, or you can reach out to the person that invited you. Once again, I thank everyone for coming. Thank you for allow me to present, and I hope what I brought to your attention, it means something to you. Just like for me, it means a lot because I have children myself, and when I see once you set up your child Index Universal Life and you know that you are building in your child future, you're gonna feel there's a certain feeling that will give you. Yeah, so thank you, everybody. Every Thursday, by the way, we do have different topic. Maybe Thursday we might have a different one. I encourage everyone to come back and see us on Thursday and have a great night. Thank you so much. I yield back to you, Emma.
Oh, thank you so much both for this great presentation. Yes, I believe tonight's topic was very interesting. We went past the hour, but we don't want to cheat you, our audience. We want to give you some time to ask the questions. We know it's past 9 p.m. Central Time. Make it quick to the question. I see Mr. Ivan's hand is up. Ivan, take it on, please.
Thank you so much, everybody, for your great presentation. It has been very informative, for real. We have been educated about financial literacy by different narratives that you put across. So we thank every one of you. You did it great, Sharon. You made it personal. I loved your presentations. They were really personal. Was and your colleague too really did great because she tackled a very important thing for the people who are having families like myself and everyone who is attending today this meeting. So as you guys were presenting, I had something in mind, and combining all the information you said, I actually narrowed it down, and I called IUL the financial salvation. Think about that. According to the presentations you made, it's actually the financial salvation that everyone deserves. So a question popped up in my mind. I'll ask this question on behalf of the people who living here in this country but have families back home. Let's say there is a husband in this country or there is a wife who is willing to have the IUL, but the beneficiaries, of course, will be back home. They don't have, let's say, legal status in this country. So I would like to ask the question for those people. How is, in case, let's say, they buy this IUL and they die in this country, how are their families going to access the death benefit? Thank you so much.
Oh, thank you so very much, Ivan. That is a very actually important question you've raised. Yes, so we do have people. Not all of us actually have all the families here. That is actually an important one. But as professionals, we always encourage you, if you really want to take a policy, I think Dr. Sharon did touch on that a little while ago. If you're taking your life insurance, there is what they call primary beneficiary and contingent beneficiary. So if you know, for example, you're taking a life insurance for yourself and your family, and some of your family members are not with you, it is always advisable for you, the primary, to be actually here. Because the point that actually we need someone to be on your application as a beneficiary. What if you're terminally ill and you're not even able to do anything? That person is going to act on your behalf. What if you accidentally actually you get into a crash and you die on spot? Your family is not here, so who is even going to get the money to be able to send you off with dignity, or even get the money for your family? So it is always advisable, yes, put your family member who is out of the country or who lives abroad, but have someone who lives here locally to be actually a primary beneficiary until your main actual beneficiary comes in. Remember, these policies are very flexible. You can put in a beneficiary today and change it next month when actually that important person of yours joins you. Or if you're young, you're single, you're not married, you have no children, put someone actually you feel like has your best interest at heart, and then later when you have that your personal person, you can switch. It is changeable. Right, so one more, so we're not going to take long, and we don't want to actually we want to take your questions. We want to hear from you. Someone else, that was good, Ivan, thank you. Someone else with a question, or you can put in the chat. I saw some people were asking if we can do some illustrations. They need to hear from us. So every Thursday, these financial literacy trainings are very normally an hour. So we know that we're not going to tackle everything on an individual basis. So that is why actually we have our numbers on the flyers, the flyer that went out. We love to sit with you. We love to sit with your family and do what we call a needs analysis. Every family has a different financial need. That is why when it comes to actually doing those illustrations and quotes and seeing what you want, we want to sit you as a family. We don't have to be physically with you. We can be on a Zoom with you and your family and look together what you need and then give you a tangible solution to what you and your family needs. So for that one, we can do that. And then someone else, I think, asked about the link. Yes, we have the links. Again, let's actually find time with you. I believe all of you who are here got the flyer. The flyer has all our contacts. Please reach out to whoever invited you. We are all here to learn together, to work with you, to work with your family, to be able to actually get a solution out. Okay, so I see someone. Corin says, if I take a loan from my cash value, do I have to pay it back? How high? So, Corin, so yes, I believe Madame Serafina did mention that. You taking a loan from your cash accumulation or your account value or your surrender value, you don't have to pay back. It is like you saying, I have 200,000 in my savings account. I want to take 100,000 out. Should I put it back for the future or should I just not put it back? So you're not required to put it back, Corinne. You all set on that one. And then another one says, since my payment go toward both cash value and life insurance, what happens to my death benefit if I withdraw to the money, if you withdraw the money? Okay, so we are trying to go fast. You bear with me because the time is running out. So when you withdraw the money, again, Collins, the Index Universal Life has two components. One is the protection, that is your life insurance. Your life insurance, you never ever touch it unless you have a critical illness, a terminal illness, or a chronic illness and you withdraw that. Or, God forbid, someone dies, the beneficiaries will get the life insurance. But the cash accumulation, that is what you withdraw. So you take out your cash accumulation, the money that you grow into your account, that is what you withdraw. So that one, you don't have to be sick. You don't have to have anything. You might be like, hey, I have 300,000 in there. I want to pay off my mortgage. Go ahead and take it out. Do whatever you want to do with it. But that is not touching your death benefit. So when you take out your cash accumulation, you still have your death benefit in there. So when someone passes, the beneficiaries will take the death benefit because it's still there. You're not touching it. We are very, very actually, Ella, yes. I will cover dependence death. However, I see something else there. We're trying to not make sure, everybody make sure we're not missing anyone. Oh, thank you. So it looks like, okay, yeah, I see some of the questions were answered. Let me know if I missed something here. But please, these discussions are here not for us to just come here and talk. We want to learn with you. We want to learn with your family. We want to dig deeper because this is just a presentation that takes just one hour and so. But when we sit with you, we really dig deeper into what you and your family needs. Anybody else before we close? We'll go 1, 2. If no one, okay, thanks done. All right, it looks like no one else had another question. Remember, everyone, this recording, this presentation has been recorded. It is going to be shared across if you really need it. If someone invited you, they will go back and share with you. They will share with you the presentation. I see someone else sent something. If someone relocates outside the US, are they still covered? Yes, yes, Ella. So we all Americans live in this country. Someone gets a job out of the country, as long as you have an account, an active account in the bank here in the US, and your premiums are being paid, yes, you are covered 100%. Because these companies believe that Americans are not tied here. You can go to work somewhere as long as you're able to pay your premiums. Yes, you are still covered. That was a good one as well. All right, so I think we'll go ahead and end it here. I'll ask my beautiful presenters to go ahead and make a short final remarks as we end this call. This was a brilliant one. Please show up again next week. If there is something you feel like you want us to tackle on money matters, we are always here. We listen and we deliver on what you want. Sharon, please go ahead.
Thank you again, everyone who came. We had a nice audience here tonight. I hope you learned something. I know I had been learning for the past few years, so I was very happy to be able to share with, my friends and colleagues. So thank you to all who came, and it was an honor to be on a panel with obviously Ms. Immaculate and Ms. Serafina. And come back again on Thursdays. We are here to educate ourselves and our communities.
Thank you. Go ahead, Madam Seraphine.
Oh, thank you again, guests. Thank you, colleagues. Thank you for a great attendance, a great question. That was really well. And I would love to see everyone again every Thursday. Come, invite somebody else. Knowledge is power. Let's share among all of us because information, you can never have too much information. The better we know, the better we can be. Thanks again, everyone.
Thank you. Thank you so very much again. I can't add more. We want to really thank you so much for this great evening. Financial freedom is what we all need. We fight for it. We need it, and we're going to tackle it. So thank you for being with us tonight. See you again next Thursday. We'll share the recording. Have a beautiful evening. Thank you.